Good morning, Anahi.
Morning, Dan.
What are we chatting about today?
Today we are going to talk about why losses stick more than wins, 401k loans versus other options, and understanding RSUs.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, financial psychology, borrowing against your retirement, and equity. We got a whole diverse variety of options today.
Yes, a little bit of everything today.
Cool. Start us off here. What are we curious about in the world of loss aversion?
Yeah, so I have always heard about how losses tend to stick longer than wins, even though if investments equal out at some point. Um, how does loss aversion affect investors?
It's probably one of the most impactful psychological factors for investors. And the basic premise here being that human beings, and there's a huge body of psychology research on this, but human beings are highly negativity biased. We do not feel positive experiences nearly as significantly as we do negative experiences. And you could kind of succinctly describe the basis for that as positive experiences are improving your life, and that's good and great and wonderful, but negative experiences, when we go back to an evolutionary frame, a negative thing just, let's say, 5,000 years ago might have been like losing your source of fire. And losing your source of fire might result in you freezing to death, starving to death, not being able to survive. And in the present, even though we're thousands of years removed from needing sticks and rocks to survive on, our evolutionary psychology has not changed very much in that time, because from a evolutionary standpoint, a couple thousand years is a very short amount of time. And so that loss aversion, that negativity bias really causes us to make quite a few fundamental mistakes and errors in judgment when it comes to our finances, because we are so predisposed towards these survival mechanisms.
I think it's something that's very interesting because it causes a lot of people to leave the market as soon as it starts to go down. But it like makes me wonder if historically they tend to level out or go back up. Why do people still feel the need to exit the market and not wait for the recovery period?
So this is where something essentially like loss aversion, and I know we keep saying loss aversion broadly here, but loss aversion itself is an actual specific behavioral and cognitive bias. So a classic example here is I look at you and say, "Hey, would you like to bet me on a coin flip, a 2 for 1 bet?" Right? So if it comes up heads, you'll get $2. If it comes up tails, I'll get $1. Right? But it comes from each other. So I'll give you two, you'll give me one. Is that a bet you're reasonably comfortable making?
I would say yes.
Okay. And the math favors you, right? If you lose $1, if I lose $2, if you win, you get $2, and if I win, I get $1. The math of this bet favors you enormously.
Yeah.
Now, let's expand this. Let's say, hey, you've got $100,000, right? So we'll make the same coin flip bet. If I win, I get your $100,000. If you win, you get $200,000. Are you comfortable making that bet?
I would keep my $100.
Yeah. And $100,000, because your fear of losing
Yeah.
$100,000 is greater than your fear of losing a dollar. And so the magnitude of loss heavily impacts our behavior, where, when the market is going up, everybody likes to pile in. Oh, it's going up. I got to get in here. There's fear of missing out. But when the market goes down, we suddenly have a much more significant negative emotion because of the decline in value that often drives people to make counterproductive decisions, like selling investments at a loss when all they had to do was hold on for a little bit longer and wait for a recovery.
So how often should people be checking their investments account? Should it be like regularly, or does it depend on how each person reacts to certain things happening in the market?
From a psychological standpoint, the less you look, the better off you'll probably be. Just from the standpoint that if you're looking at it relatively infrequently, borderlining on never, let's say like once a year, mathematically, you're probably going to see that your balance is up year over year. If you're zooming out and only looking at it every January 1st, statistically speaking, most years you're probably going to see that your balance went up and you're going to feel good about that. Now, of course, if you wait a year and then you open your account and it's down 30% from the last time you looked at it, you're going to go, "What happened all year long?" Right? And the answer is probably just that it's bad timing. The market went down in December or something like that. But in turn, there's a practical issue here, which is hey, you should fairly regularly check your bank accounts, check your credit cards, check your investment accounts, not for performance purposes, but for security purposes. You should be making sure that there aren't unauthorized charges on your credit card, that you're not going to run short of the money you need to pay for your next mortgage bill, all that sort of stuff. So it's a little bit tricky there because the succinct answer, the easy answer there is from an investment standpoint, from a psychology standpoint, the less often you look at it, the better off you'll probably be. On the other side, there's just a practical security element, right? If you ignore your money for too long, something bad could happen and you might not be any the wiser.
I feel like at a certain point, once you have invested a big portion of your net worth, it gets hard to ignore that money and just put that away and ignore it. And I can see why people can also react towards it because, like the example that you gave with the coin flip, you want to keep your money, and the risk of knowing that something can happen to the money that you have already invested can really change how you look at things or how you interpret things when it comes to the market because nothing is for sure. And with social media today, with all the things that can be spread really quickly, how do you keep clients focused on the long term when all the headlines everywhere are just talking about bad news?
I have a strange phrase for this, which is tactically branded indifference, which is to say, if any client, and every client who listens to this is going to probably recognize this from some conversation we've had before, but almost any time a client asks, or anybody in the public asks, or anybody's discussing, what about the war in Iran? What about the Strait of Hormuz? What about the crypto boom? What about the crypto crash? What about SpaceX? What about this? What about that? My answer is always this very relaxed, it is what it is, right? And part of
Mm.
why I do that is not to avoid the conversation. I'm not trying to dodge the discussion about SpaceX. I don't know what that is. Let me Google that real fast. It's not me trying to avoid the topic. It's me trying to model a behavior that says, look, money is important, investing is important, what's happening in the economy and the world is important. And also, we have a Venn diagram overlap of stuff that is important and stuff that you can control. And Epictetus teaches us that we should focus on the things that overlap. It's important that there's a war in Iran. It's important that the economy is going well or going poorly. It's important that inflation is up. It's important that the jobs reports are coming in better or worse month by month. And also, you can't do anything about that. And so, what I try to model for clients, what I try to teach clients by example is that as long as you are sufficiently disciplined and focused on the long term, you really should not care that much about what's happening in the news or on social media or what the latest and greatest boom is or the latest and greatest panic is.
So we've talked about loss aversion where the losses feel way worse than the wins feel good. What about the complete opposite on the other end of the spectrum where people get addicted to wins and forget about the losses?
Also, this is where we run into the phenomenon of the hot hand fallacy. Hot hand fallacy essentially is the idea that if you're on a hot streak, and you see this in gambling a lot, but if you're on a hot streak, you got to keep going, you got to keep riding it. You're lucky right now, so you got to strike while the iron's hot. And it's very easy for investors, gamblers, anybody experiencing the euphoria of winning, making money, getting the bets right, making money on their investments, whatever it is, it's very important to remember that every investment decision, every bet you make, every gamble you take has an independent probability of success that is not materially impacted by prior bets and prior choices. Now, it can be different from the standpoint of the market's this living mechanism. And if you buy Apple stock today and you buy it tomorrow, the underlying company has not materially changed, but maybe the news has changed slightly. And so there could be some relationship where you bought in yesterday on a big piece of good news for the market. And so everybody bought up the stock and now the stock's up 10%. And now buying it tomorrow, even though your decision to buy may not be impacted by any new news, your cost of acquisition has changed because of demand for that. But generally speaking, the probability of success in the parlance of thinking in bets, I'm forgetting the name of the author who wrote that book, but there's a book out there called Thinking in Bets. The basic idea here being that from a probability standpoint, just because you've won the last three times in a row, that bears nothing on your ability to win this time, and vice versa. Just because you've lost the last three times in a row doesn't bear any relationship to whether you're going to lose this time. The big thing to keep in mind there is a guaranteed loss is always a guaranteed loss, and there are no guaranteed wins.
Yep, I remember in one of my college classes, discrete mathematics, we most of the class was basically about a deck of cards and the probability of you winning blackjack or a certain game. And the probability of that happening was not very high most of the time. So a couple weeks back, I committed the financial planning sin of going to a casino. And I thought it was so fascinating how people would completely ignore everything that they were losing because they thought that next time is the one, third time's the charm. And they kept losing money, but they kept thinking about the one time that they won $500. So I thought that was very fascinating too. Look at the complete difference of both ends of the spectrum, where it's one where you just get addicted to the wins, and then the other end where you don't even pay attention to the wins and you just focus on the losses.
It's an interesting phenomenon here because the business model of casinos is based on the law of large numbers, right? It's like bet by bet, gamble by gamble. Your odds may not be so great or so terrible, but casinos, every game in a casino has a mathematical advantage for the casino, and the casino wins based on volume, right? So the reason that they're so aggressive about catching cheaters or people gaming the system is that they are skewing the long-term mathematics against the casino. But casinos love blackjack, even though blackjack is 49% favorable to the players and 51% favorable to the casino,
Yeah.
because in the aggregate, across a million bets, across 100 million bets, across a billion bets, you're going to win 1% of the time over your competitor. And so in the aggregate, you're going to do just fine. You get into other games like roulette, or you get into games like craps, or you get into slot machines where the odds are even worse for the players and it's even more profitable for the casinos, just in the aggregate of the long term. So they're okay with high rollers winning and having a hot streak or something like that, or being skilled gamblers such that they say, oh, we'll comp you a room, we'll comp you drinks, because what they're trying to do is get them to keep playing long enough that the average kicks in and brings them back down to zero. Or more importantly for the casino, that they actually make their money back on this person that they spent the extra money on to try to keep in the room. So it's something where, you say it's you committed the financial planning sin. The greater sin is losing a bunch of money gambling.
Yeah.
Going to a casino is fine, but again, it's this law of large numbers, right? Casinos are a zero sum game. Somebody wins, somebody loses. The market is not a zero sum game, and I think it's an important distinction because you do sometimes hear people call investing in the stock market gambling, and frankly, it's the furthest thing you could get from gambling in financial terms.
Yeah, I think that was very interesting, like seeing the both ends of the spectrum. So my next topic that I wanted to talk about was 401k loans versus other options. So when people need cash, retirement accounts might be like an easy solution. After all, it is your money. But borrowing from a 401k comes with a lot of trade-offs that I don't think people might think about. If someone needs cash, should retirement accounts be considered quote unquote an emergency fund?
So this is a tough one because fundamentally the answer here is no. Can it be? Yes, but it is a very bad emergency fund. I think a more proximal example of the comparison. I know we want to focus mostly on 401ks here, but I'll give a good example. Sometimes we see clients come in and they say, I've got $10,000 on a credit card or a HELOC and I've got $10,000 in savings. Should I pay it off? And the mathematical answer there is yes, because yes, you have an emergency fund, but you're paying out the nose and interest on this HELOC or on this credit card. And conversely, we could pay off the HELOC, or we could pay off the credit card, and we won't have an emergency fund. But as long as an emergency doesn't happen, we'll get ahead. And if an emergency does happen, bad news for everybody, we just have to go back on the credit card or back on the HELOC, but we're still in less debt than we were to begin with. So it's something where 401ks as a source of emergency funds are a little bit different, but they're not quite ideal.
It also backtracks the whole idea of having an emergency fund so that you're able to budget for your future and take care of the long-term goals that you want for yourself during retirement. So I think like when I hear people say, "Oh, after all, it is my money," I put a doubt on that. Like for example, I don't mean to put anybody out, but I have a the family friend who took money out their 401k for to buy an engagement ring. And when I heard that, I was like, "But isn't that not right?" And I was just thinking about that, how at what point do you exhaust all your other options that 401k taking from your 401k makes sense?
So here's the trick, right? I think that something like an engagement ring is not ideal, but I am sympathetic. Hey, I'm in love. I want to make an offer of spending the rest of my forever with my partner, and I'm willing to go into debt to do that sooner. It's very romantic. So I don't want to be the financial planner whose love is bad. Meh.
Yeah.
Um, but in more practical terms, when we say what is a 401k loan good for, I think, and I emphasize could, it could be useful for consolidating high interest credit card debt.
Mhm.
It could be good for reducing the cost of debt on something like a HELOC, where it's like, it's really hard for me to get this paid down, but I could borrow from the 401k and then at least I'm paying interest back to myself. It can be useful for some debt consolidation strategies, and it can be useful for certain life things. Sometimes you just need that extra $5,000 to get the down payment together to buy your house. There are just some spot points in life where a 401k loan is a reasonable mechanism for that purpose. It's just not an optimal mechanism for almost any purpose.
What are the costs and risks that people should consider before taking loans from a retirement account or their 401k plan?
Well, cost first and foremost is that you're gonna have to pay it back, and you're gonna have to pay it back with interest. And the good news is the interest goes back to you. What I typically see is prime rate plus 1 or 2%. So today that might be something like 7, 8% for a 401k loan, but that can go up or down. And at least then you're paying the interest back to yourself. But the hidden cost of that is the opportunity cost. Let's say you're 25, you're a couple of years into your work, you want to buy an engagement ring, you borrow $10,000 for the engagement ring, you're like, I'll pay myself back. Yes, but these are your earliest investment compounding years. And 6, 7, 8% interest back to yourself isn't terrible, but you're just as likely to have, let's say, a 20 or 30% year if you were a fully 100% equity type of investor and it's a good market year. So you might be leaving something as much as 2 or 3 times the rate of return as the interest is. And also, that rate of return, if it was invested in the S&P or international funds or something like, that's new money as opposed to money you already had. So there's a little bit of like a robbing Peter to pay Paul thing where, again, it could be better than paying interest to a credit card company, but we have to account for the interest that's coming out of our pocket, A, and B, we also have just the fundamental issue that we have this invisible opportunity cost. I think the biggest risk that comes with a 401k loan is quitting or getting laid off. When you quit your job or get laid off from a company where you have a 401k loan, typically you're going to have a very short amount of time to pay that loan back in a hurry, or it will be treated as a early non-qualified distribution and you'll end up paying income tax on whatever you still owe plus the 10% early distribution penalty. So now your loan that was costing you 6, 7, 8% suddenly is costing you 20, 30, 40% because you suddenly had this tax bill because you quit your job or because you got laid off or something like that.
So whenever you take a loan from your 401k, do you have to repay that back before you can also make those your contributions to the 401k?
No, you can pay the loan and make contributions. It's valuable in that you can still make contributions, still get your matching from your employer, but you have to be paying back at a minimum interest rate and on a schedule to get it paid off. So you can't treat it like a revolving line of credit forever. You do have to be on a schedule to get it paid off. But it is something where now you're double dipping because what a lot of people do say, oh gosh, I really only could afford my 3% or my 5% contribution to the 401k. And now I've got to pay off this loan and I already have to pay 7, 8, 9% relatively speaking to get it paid off because the interest is much higher. So I'll work on that. But also now I'm not going to make contributions because it's already kind of coming out of my pocket in the first place. And so then I'm leaving money on the table by not getting my matching dollars as well.
What other options can people look at before touching their retirement accounts? The differences between taking loans from quote unquote okay, your like yourself versus going out to find a bank loan.
This is something where I always want to pause before we get to the financial answer to this, right? Financial answer being take a 401k loan or consolidate your credit cards or do an interest free transfer or something. My big question is why are we in a position to need to borrow money? Because there's two basic answers here. One, sorry, there's three answers actually. One, we had a particular financial goal. I need that extra $5,000 to buy a house. Okay, that's a goal. That's a responsible type of debt you're taking on to purchase a house. Usually, not always. It's productive, generally speaking, fine. It's not perfect, but fine. The second one is there's an emergency. I didn't have an emergency fund. I was funding my 401k, and unfortunately, I now find myself in a position where I had a big car bill come up, or I had a medical emergency or something, and now I need to take the money out. Okay, again, not ideal, but fine. The third one is the problem. The third one is the truth of the matter is I have a lot of credit card debt. Just I overspend and now I'm trying to get my life back in order and I'm trying to consolidate debt in order to reduce my cost of interest and reduce my cost of capital and then I can finally get my stuff paid off and if I get my stuff paid off then I'll be better. Sure. I love the intention there, and a 401k loan, as I already mentioned earlier, could be a good way to consolidate credit card debt. But what I'm worried about is how did we get ourselves into a pattern of overspending, and what has changed about your life that says you're not going to keep doing that? That's where I get concerned about borrowing because you can certainly refinance debt and optimize financially in that sense, but there's not a lot of refinancing you can do to overcome a habit of overspending your means. And so, again, if it's for a productive purpose, buying a house or something, if it's for an emergency, I think that makes more sense. But if we're just borrowing to pay off money we borrowed somewhere else, then we're really just starting to dig ourselves a deeper hole.
There's like a line that at a certain point that if you cross, that you have to think about your actions and what led you to this point of taking a 401k because ultimately you open that 401k and or whatever retirement account that somebody has with the purpose of it being there for you during retirement. So, yeah, I agree with that where people have to first consider where what led them to the point where they're at now and why they need to take from the accounts that they have specifically accounted for something else. How much can somebody typically borrow from their 401k?
Assuming a plan permits the regulatory maximum, you can borrow the lesser, right? So you can borrow up to 50,000 or up to 50% of your balance. That said, plans do not have to offer loans. I think this is a common misnomer when we talk about things like 401k plans, people like to talk about them like they're all the same. Not all plans are made the same. Your employer, the plan sponsor, can decide to offer loans or to not offer loans. They can decide that loans are only permitted for certain purposes or not for certain purposes. They can completely disallow it. They can just say, nope, this is your retirement money. You are not allowed to borrow from it. You're not allowed to do anything with it. Too bad. That is a decision they get to make. But there's a possibility for somebody who's thinking, oh, I'll just borrow from my 401k. That's not actually an option.
That covers pretty much the 401k loans versus other options topic. The next topic that I wanted to talk about was understanding RSUs, so restricted stock units. Just wanted to fully understand them and learn more about them. How would you explain RSUs?
There's like a weird like telling a story way that just makes RSUs super easy to understand. So here's the basic story. You work for a tech company, right? That's probably the most common place you're going to see RSUs. They're not unique to tech, but that's where you just see them a lot. So you work for a tech company and you do a great job and your company comes to you and says, hey, it's review time. Here's your raise, 5%. And also, we think you deserve a bonus. You're like, great, I'd love a bonus. But instead of giving you cash, what we'd like to do is pay you the bonus in stock. You go, company stock's fine. Sure, I'll take that. Why not? And they say, but we would also like to pay it out to you over, let's say, 4 years. And if we pay it out over 4 years, we'll do that, let's say, every 6 months. So I'm going to give you a bonus, made up number here. Let's say $80,000 in company stock based on today's value. But I'm going to pay it out to you $10,000 worth of stock every 6 months for the next 4 years. That's the basic idea of what's happening here. So instead of getting paid a bonus immediately all at once, we're being paid a bonus in the form of stock instead of cash. And it's typically
Mhm.
being done over time. And if I quit, leave, get fired in between now and when those vesting periods happen, it just goes away.
Okay. And then so at what point is like having company stock too much company stock for somebody? Like at what point does it stop like making sense or like because you're fully concentrated on just one stock? At what point is it too much?
So here's the funny thing about that, right? Financial planners are trained and educated to hedge risk as a primary motivator for a lot of financial decision making. So I don't know that there's an objective number about how much stock is too much. It's not, oh, if you have more than $1 million of company stock, you should never have more than $1 million. It's not that type of scenario. The bigger question here becomes, I think, the answer to this question, which is, okay, take that whole setup. What if they said, "Oh, we changed our mind. We're not going to pay you in stock. We will actually pay you in cash. Same vesting, same all of that, but we'll pay you cash instead." Question: would you, when you receive that bonus, would your first decision be to run out there and go buy the company stock? First question. For most people, the answer is no. It's not to say that they wouldn't buy the company stock ever, but if I get said, and I am paying you a $10,000 bonus, do you want to buy some My Wealth Planner stock? Your first answer is probably no, right? It's probably not the first thing that comes to mind as far as what you want to spend money on. But later in your career, when you're making better money and you own your house and you have a more comfortable status quo, et cetera, you might say, sure, I might invest in my wealth planners or whatever company I work for. So that's the first element here is that because you're buying company stock, you are forced into a decision about keeping the stock or selling the stock. And then the question that you asked, how much is too much? If I'm an NVIDIA employee or a Micron employee or a SpaceX employee or an Anthropic employee, there is no such thing as too much because those
Yeah.
companies have done phenomenally well and are expected to do phenomenally well here in the near future. So it's something where you look at that and say, gosh, if I work for a big up and comer, that's going to be the path forward for me. That's going to work out great for me. At the same time, I'm pretty sure some people who worked at companies like Blockbuster or Lucent or Enron also had lots of company stock. And surprise, through the lens of history, it didn't work out so well. So all of this to come back to, I think company stock can be a great form of compensation because it creates better alignment between you as the employee and the employer because you're being paid over time. There's a vesting schedule, but also because your bonus can get bigger. It's based on the value when on the date that they grant it to you, but you get a number of shares based on the share price value when it vests. So if they said, here's going to be 400 shares over the next 8 years, $50 every 6 months, if the share price doubles, your bonus double. It's like there's some good incentive alignment that goes with that. But all this to answer your question, how much is too much? Anything more concentrated or anything you could not afford to lose is too much.
So what is something other than employees considering what they would do if the difference between getting that bonus in cash or in stock? What is something else that employees should consider before accepting the RSUs?
Let's just to be clear here, this is not optional typically, right? If you're offered RSUs, it is
Oh,
part of your compensation. And if you're working at the company 6 months in the future, 12 months in the future, whenever the vesting's coming up, you're gonna get those shares. Unless there's like a performance condition, you must remain a top 10% performer to receive these stocks. And if not, you don't get them or something like that. So you're gonna get them. But bear in mind, I can receive these RSUs when they vest and I get them, and taxes are withheld. Some of the RSUs are sold automatically to pay the income and payroll taxes that I would have to pay on these anyway if it was a normal bonus. I could then immediately turn around and sell them and say, oh, thanks for the RSUs. I'm going to convert these to cash instantly. You can do that. There's nothing stopping you from doing that unless you're a insider at a company where you're subject to a trading plan, but that really requires you to be like a C-suite or close to C-suite employee at one of these companies. But assuming that otherwise you're just a rank and file, you're a systems engineer, software engineer, project manager, something like that, and you're getting a $50,000 RSU bonus this year, you might have something like $10,000 withheld for taxes. You've got $40,000 in stock and invested today. Nothing stops you from going to the market and selling it today.
so the incentive here, if somebody wanted to hold on to their shares instead of selling them right away, is the probability of the stock going up, right?
Well, it's the probability of stock going up, but it's the probability of the stock going up between the grant and the vesting date. So I'll give you a good example. We have a lot of clients who've been with, again, I keep saying software companies, so that's where I see it the most. We have some clients who work for companies like Apple, Oracle, Amazon, who are paid a tranche of RSUs granting and vesting over 4 years. So you get a grant today, it's going to vest between now and 4 years from now. And then next year they have a review and they get another grant. And the next year they have another review and they get another grant. The next year they have another review and they get another grant. And that can produce an environment in which they are then receiving even equal to or sometimes more than their annual salary in these vesting RSUs, particularly if the stock price has been going up the whole time. So I'll give an example. We have a client out there whose salary is close to 300,000. He's a senior director level person at a big company everybody has heard of. And he makes $300,000 in salary, but he makes almost $1 million more in stock compensation every year because on a rolling 4 year basis, he keeps getting more and more RSU tranches. And in the first year, he was only getting one. In the second year, he's getting two. And the third year, he's getting three. And from the fourth year of his time at the company and beyond, he's had this rolling 4 years worth of vesting happening every single year.
What about for tax planning considerations? So it's like we've mentioned, it's a lot of money that's coming into you, or I guess it's stock first, but if you choose to keep it or sell it or do something with it, what tax planning considerations should somebody pay attention to?
So the trick there is you need to make some cursory decisions, and you can always change your mind, just to be clear here, but you need to make some cursory decisions. When you get the grant, you have the option to do what's called an 83B election. 83B election allows you to recognize all of the stock immediately and pay the taxes on it all immediately. And you go, why would I accelerate taxable income? Because it starts the clock on long-term capital gains with respect to the appreciation. So to give you the hypothetical here, if the stock was worth 100 on the date of the grant, and it's not going to vest for another, let's say, 2 years, and 2 years from now it's worth $200, you'll pay income tax in 2 years as if you had been given a bonus of $200 because you were given a bonus of $200 at that point. But if you paid taxes on the original $100 value back when you first got the grant, then rather you'll pay the taxes, the income tax, or let's call it 30% on the $100 today. And when it vests later, you don't necessarily have to pay taxes on that value, but when you then later sell it, you'll only be paying long-term capital gains tax, which might be closer to 15 or 20%. However, that bet involves having the money to pay the taxes now, and it also involves the decision to believe that the stock will be up in the future. Because if the stock's down in the future, too bad, so sad, you don't get your money back on the taxes. So just keeping in mind that it's a concentrated bet that requires you to be certain you're going to be working here over the next couple of years and be very confident in the value of the stock to go up. That's the biggest one. Otherwise, assuming that we're then just letting it ride, waiting until vesting happens, we then need to make another decision. Am I selling right now or am I holding on to this? If I'm selling right now, it's fine. We're just, we got a bonus in stock. We turned it to cash. It's cash now. It's fine. If we're going to wait on it, now we probably want to think about holding it for at least a year to get the long-term capital gains on the sale. And the sale there will be, and the tax will be on the difference between the value on the vesting date and the future date of sale. So if I sell it within the next year, I'm going to pay regular income tax. If I wait at least a year, I'll get to pay long-term capital gains. Again, this is all subject to the belief and the assumption that the value of the stock will go up. If it goes down, there's not really any advantage here.
How do we as financial planners plan around the RSUs? How do we treat those?
There's an old expression in investing, which is that concentration builds wealth and diversification protects wealth. So when a client's early in their career, they're in their late 20s, they're getting their first tranche of RSUs, working at a tech startup or something like that, we often treat that like a high risk, high reward Hail Mary bet and say, hey, unless you have short term goals that we need to fund by converting your stock into cash, if we can do that, because some companies will grant RSUs that are not liquid, then in that particular case, let's just go ahead and convert it to cash and use it for those short-term goals. But if you're in that later mid-career, whatever it is, you're like, yeah, I'm comfortable. I've got my house paid for. My kid's college is funded. I don't need the money in a serious sense. And I'm funding my 401k and it's diversified. My spouse is funding their 401k and it's diversified. Then we might say, hey, do we want to hold on to some of this as a high risk, high reward bet? And then it's just a question of discounting how much do we want to concentrate our wealth in that particular company, because that concentration could be hugely valuable. Again, if you work at a company like Nvidia or Micron right now and you had RSUs or a stock purchase plan, you are very happy that you have those. But again, if you worked for a company like Enron, you were pretty sad that you had those. So it's just a risk management question at that point.
Once you get to the C-suite level of a company or something, I am pretty sure it's very hard for them to get laid off or something happening where they leave the company. But what if they do? What happens to the RSUs if they haven't vested yet?
I'm going to push back on that, right? C-suite people get paid so much because they are highly performance driven. At least they're supposed to
Mhm.
be. That's the whole point here is we're going to pay you ridiculous sums of money, particularly with a lot of incentive compensation to grow the profit of the company, increase revenue, increase all of that. And if you don't get paid it, we fire you, right? Then the question there is if you quit, if you leave, if you do get laid off, it just depends on the terms of your contract. When we talk about RSUs, we're typically talking about a form of equity based bonus compensation that's very typical for kind of either employees who are in high risk industries where equity is a good replacement for cash, where they don't have a lot of money. Think about startups there. Or you see it for a lot of mid career managers, engineers, those sorts of folks in well established companies with decent stock plans. Otherwise, when you get to the executive level, it tends to be a lot more negotiated, right? It's not going to be a time-based RSU schedule. It's going to be more like a if you raise profit or EBITDA or something like that by 15% year over year, we will grant you 10,000 shares of company stock. And if you don't get any of it, so it tends to be a little bit more conditional for executives.
Oh, okay. Okay, I see. Okay, that pretty much covers all the topics that I wanted to talk about, and you answered all the questions that I had.
Then you know what I'm going to ask, which is, as always, since last time you were on the podcast, what have you learned that you want to share with our audience?
Yeah, so something that I learned since the last time I was in the podcast is that fixed rate mortgage doesn't always mean a fixed monthly payment. So even though the interest rate stays the same, the total payment can still fluctuate over time. So property taxes and homeowners insurance are often included in the escrow payment, and those costs can change year to year. So if taxes and insurance goes up and the escrow amount doesn't have enough to cover, the lender will adjust the payment. So they typically will spread out the shortage over the next 12 months, which can cause a jump in the monthly payments. I think that this is something important to know for first time home buyers, especially for someone who is budgeting tightly around their mortgage, that the payment isn't always going to be as fixed as it sounds.
Yeah, the cost of the debt doesn't necessarily change, but the property tax, the insurance, not to mention just maintenance and upkeep can be a big factor. Like when we bought our house, the assumed escrow payment for property tax was so much higher than the actual property tax bill. I think we got three escrow refunds, which is when you get to 2.5 times the annual expected cost of escrow, they will refund you. And because our property tax and our insurance kept coming in way lower than the escrow estimates, we ended up getting refunds a couple times. And then in turn, sometimes you hear about people where the escrow estimates are so below the line and then insurance goes up or property tax jumps up that suddenly the escrow company's high. We need to increase your monthly payment or we need you to write us a check for this much to true it up, which is not so much fun.
No, it is not. But that has happened to us where we get a refund for the past 2 years, and then we never paid much attention to it, but obviously lost aversion. We saw the payment go up this, I think, 2 months ago, and then it was like a jump scare. It just went up out of nowhere. We were like, we thought that the payment was going to stay the same, and come to find out, it won't.
Yeah. And again, your cost of debt has not changed, but
Mhm.
unfortunately, insurance and property tax are not so guaranteed.
Yep.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.